Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio, we have Justin Burgin, Vice President of Equity Research at Ameriprise Financial. He's here to discuss inflation, interest rate earnings, and why a barbell strategy is the best approach for investors right now. Justin, it's great to have you with us. Welcome to Trade Talks.
Thanks for being.
All right, let's talk about inflation. It just feels like getting it down where the Fed wants to get it to is very sticky at this point.
You're absolutely right, and I think that last mile is going to be tough. And you look at some of the data that's come out with the spending information coming in from consumers higher than expected, that makes it that much harder. So we're looking at mid to late next year when you can get that back towards the Fed's target.
So it feels like it's going to be higher rates for longer. When do you think they start to perhaps talk about cutting rates?
Yeah, that's also our expectation is in the back half of 24, you can see modest 25 basis point cuts. 2 of them is what we're baking in for the end of next year.
And when it comes to earnings, it feels like there's something else to talk about now in terms of a near-term catalyst, right? We're not just so hyper-focused on inflation and the Fed. They've been okay, right? Since, the banks, I believe 20 of 21 have beat their earnings. How do you think the financials have performed, and what do you expect for the rest of the season?
Yeah, it's been pretty choppy. It was good to see we started off very well. If you look at expectations for earnings growth and financials is about 8.5% year-over-year growth. It's over 14% now. So that's a good sign, but it's been very choppy on the individual stock sector or individual stock side. So I think it sets a good tone. Comments regarding consumers was good. There's been some slowdown in the banking side, but there's not a fall off in some of the net interest margin and deposit data that we're afraid of.
So let's talk about that, the barbell approach. Explain to us what a barbell approach is and what sectors are more opportunistic than others.
Yep, absolutely. So if you think about cyclical and defensive, we're overweight technology, which has worked very well this year, but we're also overweight staples. And consumer staples are considered defensive, but when you look at some of the numbers that have come out this year, P&G came out this week, PepsiCo came out, very good numbers. And what you're setting up that even though that volume growth that they're seeing isn't there now, the pricing is continuing to come through, and that's helping those numbers. And I think even P&G said that expect 800 or 900 million in savings next year from lower commodity costs. So we think that's a good place to be.
So when you talk about this barbell approach, you have tech on one side, right, and then you have cyclicals on the other. Is there anything sort of in between where you're seeing any opportunity, or it's really those two sectors that stand out?
Yeah, so I'll go back to financials, right? Again, that was, you may have some headwinds, but it's nice to see that that worst fear isn't on the table anymore. And I think that gives you some, your safety, at least from dividends are okay, and the buybacks can come back later in next year.
Right, and to your point, the consumer really has been the story, certainly through the pandemic. Do you think there is still enough strength there to kind of get us through the other side into 2024? You know, credit card balances are rising. We know student loan payments are coming, but I feel like every time we are stacking negatives against the consumer, they just continue to perform.
Yep, it has been, the death of the consumer has been talked about for a year and a half now. And I think you have to think about when you look at consumer spending and what they have, it's come down, and we're seeing a slowdown, but it's not that fall off the cliff type activity that people are expecting. So if you can, and that really is what gets you into that kind of soft landing, is the consumer is just pulling back gradually. And that's kind of what we see taking place over the course of next year.
Well, I mean, especially if the labor market continues to stay hot, it's not like you have, an entire segment of the workforce where it's just dropping off a cliff.
3.8%, if you have a job, you're spending, right?
Yeah.
And that's typically how it goes. So I think part of the problem is, people have taken a historical playbook and tried to put that into the current environment, and it doesn't work, right? So you have, if you look at the last recessions, consumer leverage was very high. It's not there anymore. That's not the problem. So I think the playbook you have used doesn't work as well now, but you just have this general pulling back from the consumer, but not a drop off.
See, it's interesting you talk about historical perspective, because this recession that has failed to materialize, we keep hearing about the yield curve and it's inverted and the signals we're going to have a recession. I mean, it just hasn't materialized. Right.
And if you look at, coming into this year, we were 50-50 as a firm on expectations for recession. We're below that now. So we're taking the camp that you're not going to see that. We also think that the Fed is done on raising rates.
All right, Justin, appreciate the insight. Thanks for joining us.
Absolutely.
And thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.